See.
Good morning. Thank you for joining us for today's webcast, the third annual Construction Industry Kickoff presented by Ray & Associates, the top 100 regional CPA and business consulting firm with offices across Ohio, and Overmyer Hall Associates, a leading insurance industry in Central Ohio. My name is Imani Fields, and I'll be walking you through a few housekeeping items for today's webinar. First, if you have any questions during today's presentation, you may enter them into the chat box on your screen. We will try to answer as many questions as we can at the conclusion of today's presentation. However, to be respectful of your time, we know that we will not be able to get to them all. Therefore, following today's webinar, we will review all questions and send out the answers via email as soon as we can. If you'd like a copy of today's slides, you'll find that they're available in the handout section of the webinar dashboard on your computer screen. Today's webinar will be moderated by Doug Hauser. Doug is a principal and director of Ray & Associates Construction and Real Estate Practice. With over 25 years of experience, Doug oversees the firm's efforts in growth and relationship management for his client segment, which is the firm's second largest. Doug's focus revolves around financial reporting considerations and guidance for the firm's construction clients and their third-party financial statement users. Next, today's presenters are Jack Kehl, Dave Catanese, Scott Bechtel, and Joe Urquhart. Scott oversees tax engagements and related client relationships. He works with clients in industries including construction and real estate, manufacturing, and service industries. He also works with associates at Ray to develop them in all areas of their careers. His areas of expertise include construction industry tax, multi-state, city taxation, leadership development, tax planning, entity and individual and succession/ownership transfer. Jack Kehl has more than 25 years of experience solving problems and crafting solutions for the construction and surety industry. Prior to joining Overmyer Hall in 2012, Jack was vice president of Surety for Willis Group Holdings. Previous to his position, he was senior bond underwriter for a regional insurance carrier. He's active in many construction-related organizations, serving both board and committee positions. David Catanese is a construction and surety bond advisor with Overmyer Hall Associates. Dave grew up in Northeast Ohio and graduated from Ashland University, where he earned a bachelor's in business administration. He also holds an associate fidelity and surety bond designation from the Insurance Institute of America. He has more than 15 years of experience in creating solutions for the surety and construction industry. And finally, Joe Urquhart at Overmyer Hall specializes in insurance and risk management programs for all contractors, real estate developers, and manufacturers. As vice president, Joe advises clients on insurance issues such as risk transfer, builder's risk, additional insured, professional liability, and loss control. And now I'll pass it over to you, Doug.
Thank you, Imani. Thanks for the introductions, and good morning, everybody. We're going to let everybody take a few minutes, fill up your coffee or whatever your beverage of choice is here this morning before we get the presentations kicked off. Pleased to be with you again. Wish we were in person, as we historically have been at Ohio State when we do this event. It's always fun to see everybody and get together, and hopefully we can do that again here soon. But we're doing our best virtually as we come from various locales around Ohio. So thanks again for everybody for being here today. You should have received an email from us with a gift card, Starbucks gift card. So I will let everybody know that there is that in your email. Perhaps it went to spam. It is not, in fact, anything that you should worry about. It is a valid gift card that we sent to everybody, all the attendees, and some of the early signups will receive a nice follow-up gift from us as well. So look for that forthcoming in the next week or so. And with that, we'll throw it around for some initial comments before we get into the formal presentation. Also a reminder that the slide deck is available, will be sent to everybody as a follow-up as well, but it is available for everybody. So with that, Scott, you're going to be covering some tax topics today. A lot to go through, certainly as once you get into that. But any initial comments for the group?
Yeah, I think the main thing is just providing an overview of a lot of the things that are going on in the tax world right now, as it relates to some of the PPP things, as well as the election results and There's a lot going on, and we'll try to hit on a variety of topics.
Awesome. Yeah, there's just so much complexity with everything related to the tax world these days, the employer retention credit, which they've redone a number of times, PPP and everything else. So look forward to that. And Dave, how about you? What do you, any initial comments for the group?
Just looking forward to sharing some of my experience and what's going on in the surety marketplace. I know it's an important piece for everybody, or most of the people that will be attending here today. So look forward to that.
Excellent. Yes. And Jack, we were talking before, as all of us were on, a lot of mixed signals out there. So we'll give our best guess as to what we see in talking to folks around the state and region. But it's hard to peg right now, isn't it? Don't you think?
It is really dynamic, right? So my advice is stay nimble. Don't lock into a particular direction because things are changing so much. Just be ready to move when the opportunity's there, and don't operate out of an attitude of scarcity, right? You don't have to panic. Things are progressing actually pretty nicely right now.
Yeah, I would agree. The fear that we had when COVID first hit about, liquidity and financing and projects, just, everything getting canceled, where we're going to see another Great Recession as we did kind of, 9-10 time frame, largely hasn't come to fruition unless you're within a few unfortunate segments. So I think that is that's favorable, but yes, overall some mixed signals, and we will get into some of the finer points in terms of what we see. Joe, how about you? What's your feel right now as you're out there?
Kind of just a quick reflection. It was hard to believe we did this last year in person in January. Who would have thought in another 30 or 60 days our world would have been turned upside down, right? Who knew? And I think it's gotten through it. I look forward to a new year, but obviously we have definitely a few months or whatever it's going to turn out to be before we start to get back to normal. And all this change has definitely created on my side, some new risks, new liabilities, some definitely unknowns, some uncharted waters, but you can see light at the end of the tunnel, I think.
Yeah, I think that's that's some good wisdom there. It's it's really different. It's certainly a different feel than we had during that Great Recession time when everything, every business, every industry was suffering. We didn't know if the whole financial market setup was going to collapse, and what we saw ahead. I think we're certainly in better shape this time, but not without our challenges, and we'll talk about that, where we see some headwinds in certain areas and some tailwinds in a few others. And it's certainly an interesting time overall. I think, and we'll get into this, some of the macro level stuff. That's going to be our approach today. Talk about more the overall economy and some macro trends and things that we see, as well as some micro trends, stuff that we see within the region that are perhaps a little bit different than what we see overall. And I think it's always interesting to look at those things, depending on where you're located geographically. So Dave, you get around the state quite a bit. So do you notice a lot of difference as you travel kind of all over the state?
I do actually. Toledo, Cleveland, Akron didn't do poorly in 2020, but certainly the prospect for future growth is definitely weighted towards Central Ohio and Columbus. Columbus being the capital of the state, Ohio State, the population growth are all absolutely leading construction in a positive direction.
Yeah, I would agree. So yeah, it's interesting when you talk to, for example, the economic development folks like at One Columbus, and they travel all over the country and the world, and to hear their perspective on different regional fields and the competition and all of that. We'll get into that a little bit as well. So any final comments from the group before we get started here? We'll let folks fill up on their coffee one last time, and we'll get into the formal presentation a couple minutes early here. Guys, any last comments before we get going? All right.
Just your questions.
Yep. Remember, if you put the questions in the box, we will get to those during the presentation and do our best to make this interactive. So please do interrupt with those questions, and we want to make this a little bit more discussion oriented. We do have a lot of information in the deck today. We're going to whiz through some of this pretty quickly. That's on purpose. We'd rather that we discuss some of this and have a little back and forth, but all of the information that's in the deck is really valuable. So I encourage you to take a look at that after the fact, because we've got a lot of good data in there. So with that, we will kick it off. And Abby, you can go ahead and get started. Next slide, please. Perhaps. There we go. All right. So, one of the things, and we talked a little bit about this in the intro, and I think this is very interesting. If you look at the Mid-Ohio Regional Planning Commission, or MORPC, their data, if you look at the state of Ohio's own data and look at the population projections, they vary a bit, but I think this is important as we move forward. And you can see that overall the state's growth is projected to be fairly flat. However, that growth is really disparate across the state. If you look at kind of Northeast Ohio, Cleveland area, Youngstown area, as well as Montgomery County, Dayton area, some of the Stark counties. What we did here was highlight any counties that were showing growth of 10,000 or more folks. Significant growth obviously is expected to continue in the Central Ohio MSA. Franklin, Delaware, Licking, Fairfield, Union. I mean, you look at that list there. Now, Mid-Ohio Regional Planning Commission is even more bullish. They project that we're going to add 1 million people in the next 20 to 25 years in the Central Ohio MSA. That's just astounding to me. We're at 2.2 million in this region now, and if we get to 3.2 million, that's a lot of growth that we need to deal with. And the other statistic I found interesting here, if you look at this, nearly 40% of the dollars committed for Tier 1 ODOT projects over the next 4 years are in Central Ohio. To me, that says a lot too. I mean, again, the state, I think, is all over this. They see the trends. They know what's going on here. So I think it behooves all of us to kind of pay attention to these macro trends within the state in terms of demographics and population, because infrastructure and all the things related to that must follow. So next slide, please, Abby. So just an overall jobs forecast. This is, again, provided by ODJFS. They tend to be very conservative in their overall projections, but despite that, they still show that the construction industry should have strong job growth over the next 5 years or so, north of 10%. And digging even a little bit deeper into that, the Central Ohio MSA, which we talked about just previously, kind of leads the way there. They project almost 12% growth in construction jobs within this market. And again, this dovetails with what we see from both Mid-Ohio Regional Planning Commission, the state itself, all of their data mining that they do, really projects fairly robust job growth particularly in the region, but certainly for the industry as a whole, which I think is a great thing. Obviously, if you look at the other industries that are close to that, really it's healthcare and then, construction. The others, certainly there's some pockets of good growth in terms of finance, real estate, other things like that, but healthcare and construction should lead the way. So good to see. Next slide, please. This is, we've gotten some recent data here. Obviously, 2020 declined a bit due to the initial hit from COVID. The projection here in the region is that we will bounce back quickly and in many ways already have. So I think it's just as interesting to look at this trend over the last, obviously, 12 to 14 years that's here, and how we've really rebounded nicely since that Great Recession time, which we reflected on in our opening. Certainly this, the initial hit from COVID, there was a lot of concern. The stimulus that was put out there related to PPP, and fortunately construction was deemed essential in Ohio and wasn't shut down. For example, Pennsylvania, if you looked at it, looks a lot different because they were shut down there. But this job growth here in 2021 and beyond, it's going to continue this upward trend again, which is great to see, but certainly poses challenges as we take a look at finding labor and getting the right mix in terms of efficiency and performance and all of those things. So again, pretty robust recovery pretty quickly in construction. Next slide, please. So I thought this was interesting too, and we'll talk about each of these in a little bit of detail. This is a micro breakdown of material cost increases and installation cost increases, in other words, labor, and a little bit of a breakdown between markets. You can see that Columbus and Cincinnati outpace the rest in terms of that cost inflation versus some other areas. So this top chart here on the top left of this slide kind of illustrates that. It's not unexpected, I guess, but it's interesting to look at this kind of micro level data and even the differences that you might see across the state. If you look at for example, Akron Canton versus say Columbus and again Cincinnati area, those are the areas where we've seen the greatest increases, and again, given the activity, not unexpected. Material cost changes, the graph and chart here in the bottom left of this slide. Again, many of you have experienced this. We're seeing significant cost increases in roof membrane, insulating glass, copper as well. Obviously, some other items we saw some price decreases. So the trends have kind of been all over the place with that. Some of that supply chain issues, depending on where the material is sourced, all of those things. Obviously the other big one, as we flip over to kind of a residential cost look over on the right side of this slide, is lumber. Everybody's been keenly aware of that. It's been at record highs, although it did decline a bit in the fall. It's continued to ramp up since then. And whether that can be abated here in 21 remains to be seen. I'm certainly not an expert there, but it's contributed to a significant increase in the average cost of a new home build, up over $16,000 in 2020. And that is just astounding to me. I mean, I used to deal with a number of material suppliers back in my banking days, and we'd see lumber bounce around a little bit depending on some environmental conditions in the Pacific Northwest and Canada, but nothing quite ever like this. So, I think that's going to lead to some innovation too, where we see more alternative materials being used, but if this trend continues, it will be interesting to see. We've got a big housing shortage that we've got to deal with, which we're going to get into here shortly. So it all kind of plays into that. So very, very mixed overall in terms of materials, but certainly big spikes here as we see in some of these. So next slide, please, Abby. This is the key for me. You know, if I go back and look at this, you know, 30-year history, it's unbelievable how this has really moved all over the map in terms of U.S. residential construction and how different that has looked. Obviously, the significant decline that we saw in the just preceding and during the Great Recession, it's just surprising to me that it hasn't picked up more than that since that time. I really would have expected the blue line here at the as we look at the right side of this graph to have shown more of an increase over the last decade or so, and multifamily as well. We continue to see and hear about a lot of multifamily projects and all of that, but it's really overall not still happening at the pace that it needs to. And particularly when you go back and compare it to 30 years ago, I mean, it's astounding how much of a decrease that is. And I think because of that, and we're seeing it certainly in housing prices and everything else, we have a significant shortage of housing in certain markets. And if you talk to some of the economic development folks, that they will say that is the #1 challenge for them overall. It's really scary when you think about it. If we're going to add, say, 1 million people in the Central Ohio MSA over the next, say, 15 to 25 years, we need more housing, big time, and it's a challenge to get it done. So, next slide, please. And this, dovetails just with that. Look at the average home price index over the last, here we're going back 25 years now. It certainly makes sense. We've got a lack of supply, so what happens is prices go up. I just saw some data released yesterday that looked at all the large metros throughout the country. Columbus actually had the 4th highest price increase in housing costs, residential housing costs in 2020. It was 13.8%. Up there with some of the major high growth areas in the country, and that's again that's kind of a scary thing. We need more housing supply because this continued rise in price at this rate really isn't sustainable. So hopefully we can address that. Next slide, please. Again, this goes to the lack of supply overall. If you take a look at the data provided by Mid-Ohio Regional Planning Commission, the state of Ohio, to meet the projected growth in the region, you need 14,000 housing units a year. We're far short of that in terms of permits, even though it's grown significantly the last couple of years. We're at just north of 10,000. Again, that permits is the leading indicator, obviously, of projected construction to come, but we've got ways to go to get there. So, just pointing out, even though if you drive around the region and you think, gosh, there's housing going up everywhere, it's still not enough. And that's just, I know it's hard to believe sometimes the empirical evidence that we each see points otherwise, but we're still vastly short of where we need to be. And again, you hear this from the economic development folks. It's one of the major concerns as companies come here to visit and look. We've got so many positives, obviously, in the region, but affordable housing is always one of those at the top of the list that we need to solve. Next slide, please. So, again, no surprise here looking at some of the commercial real estate trends. multifamily and industrial, which, warehousing and things like that, continues to see really good price appreciation and overall demand. Retail obviously has changed significantly and probably permanently. I'm certainly not an expert in the retail segment, but when you talk to those that are, that it's just amazing the adaptation that's already been accelerated because of COVID, and those that can adapt and change their models quickly, I think will be winners. And obviously those that can't are going to suffer. So the future of how that looks is very, very different. And certainly all of our personal habits have changed as it relates to retail. So it'll be interesting to see how quickly those changes occur and how that adapts. And I know I was looking at some overall retail penetration data in terms of commercial real estate, and I was surprised to learn that the overall data showed that they felt, for example, that Central Ohio was under retailed, and that just blew me away, because I've always thought it was anything over retailed. But people a lot smarter than me look at all this data, and obviously there's growth projections in there and how that's brought to market. But that really surprised me. Quick commentary on the office part. We're seeing a big difference between suburban office and central business district office. I know the projections I've seen for 21 tend to show another 6 to 8% decline in central business district office space rental and lease rates. However, suburban office lease rates are projected to be up this year. So I thought that was quite interesting. We think, oh my gosh, all this COVID stuff and the office space is dead, et cetera, et cetera. I think far from it. It will be back, and it'll be back, I think, quite strongly, particularly in certain markets, but it'll be different. So maybe the trend might be slightly away from some central business district stuff to some suburban locales. That's at least the initial thoughts of some of the folks. But again, where there's value, there will be demand. So be interesting to follow. Next slide, please. This was a recent survey that was done, CB Richard Ellis, which does a lot of polling in the commercial real estate industry. Again, going to what we talked about, the biggest bounce back and quickest in terms of demand and appreciation. Start at the top with industrial and warehousing. Second, multifamily. Third, suburban office. Again, this kind of goes to that bifurcation between suburban and central business district, which is at the bottom, and then retail slightly above that. So will be interesting to follow. That's for sure. But we shall see. Next slide, please. So if you take a look at this is from the Commercial Mortgage Bankers Association. Look at their origination index, which is obviously a good leader in terms of what you see and will see in terms of growth. I know this is a little bit of a busy chart, but take a look at the far right column here, percent change in each of those sectors. Again, the strongest sectors are going to continue to be multifamily, industrial, and healthcare. If you look at these, retail was already declining, 17, 18, 19, 20, continued to show decline. So again, a rethinking of what retail looks like and what that means. Certainly will be a trend. The hospitality, hotel industry, that obviously has taken a massive hit, particularly in terms of business travelers. All the projections say that the leisure travelers, that will rebound much more quickly than business travel. I think obviously we've all learned how to do better with Zoom and all of the technologies that we've got. It would certainly will rebound, but how much, hard to say. But it's interesting if you look at these trends again going the last 3 or 4 years. It just really, COVID just, as we say here, exacerbated what was already underway. So next slide, please. Interest rate forecast. So we're going to get into a little bit of the financing area and what the markets look like for that. I think we're overall in really good shape. Obviously, as everybody can see, money is cheap. It's darn near free. If any of you've tried to refinance or get a new mortgage, I mean, you're talking rates that are below 3%. I mean, it's just it's astounding. I mean, we're 12 years, 13 years on from the start of the Great Recession, and money has pretty much been as close to free as you can get it for that whole time. If I would have lost a lot of money betting that would not be the case here again 13 years on, that we would have started to see some inflation and some rising rates. The Fed very much wants to push that. Can they make it happen? I don't think so in 21 for sure. We'll see as we get beyond that. It's hard to get much clarity for me, at least beyond this year, but I think money's going to continue to be cheap throughout this year, which is good if you've got projects and investment in that you need capital for. Borrowing costs will be favorable. If you're a saver and have excess liquidity, obviously not so much. Next slide, please. Again, this goes to what we see now. Obviously, a lot of this was due to PPP, but the banks overall are just very flush with liquidity. They've got a ton of money. They want to lend, but they're certainly taking a hard look through their underwriting processes at individual businesses and industries and how they have been impacted by COVID. I think that's the most difficult thing for everybody to understand is take a look at what the macro trends are for that industry and what the impact is. If you think about how a bank underwrites, they want to look at and get their best idea of what's ahead for your business. And when we were initially hit by COVID, nobody was sure of that. We have more clarity around that now. I think it's great that the banks are in tremendous shape. You look at their balance sheets, again, they've got a ton of deposits. They want to lend, they want to deploy that capital because that's how they make money. So the environment, if you want to do a deal or have capital expenditures or growing, it's a great environment to be able to do that right now, unlike what we saw in the Great Recession. So this, more than anything else, really makes me think that it's not just light at the end of the tunnel. I mean, we're poised for some real opportunity because there's an abundance of capital that's ready to be deployed, and I think that's hugely positive. So great to see that the banks are in good shape. Next slide, please. I'm going to blow through these real quickly because Dave's going to talk about more of a macro overall look at the construction sector. This is from Construction Analytics. So I'm not going to talk about it. You can have it in your deck and look at it, but it goes to a lot of what we've seen. So next slide, please. Same here, individual sector data. Again, I'm not going to get into commentary on this because Dave's going to cover a lot of this, but more good data for you to have as you look at individual segments. I'm a big believer in construction analytics and the work that Ed does there. So take a look at this as part of your follow-up. Next slide, please, Abby. This was really interesting to me. So this is deal flow. Again, going back to capital availability, if you look at where multiples were in the construction industry, this is M&A data. This is also, for example, ESOPs that are done. You look at the multiples in the industry. Obviously, they were very robust going into COVID. And I can tell you that, if anything, post-COVID, the multiples that we're seeing in the construction sector, if anything, are better. And this data points to that. This is from Capital IQ. This is national deal flow data. I mean, you look at those multiples, you're still at 6 and 7 times, depending on the specialty here. And we've seen that. The deals that we've been a part of for clients and prospective clients have continued to be quite strong. Again, I think there's 2 reasons for that. The banks do have capital. Also, there's a lot, certainly as everybody knows, there's a lot of private equity out there. And another thing, construction has fared obviously better than many other industries. So if anything, it's become more attractive than it was even pre-pandemic. Now, how long that will hold, hard to say, but you know, as I always say, one of the best things about construction is you can't outsource it. You know, to a large degree, it's still got to be done at the local level. So those that have a service component to their business, as well as obviously new construction and things like that. I mean, we just continue to see the valuations and multiples and deals that have been done be quite strong. And I think that bodes well for the industry. I always think those, whether you like or not, a lot of those private equity folks on a national level, they're smart people. And the fact that they're willing to invest and still pay even more of a premium for companies in the industry, I think says a heck of a lot, and that's quite positive. So love to see that, and I think that certainly bodes well for the near future for the industry. Next slide, please. Just want to close with this. I always like to remind folks, we do a pretty good job at this, but I always think we can do better, you know, certainly within our firm. But having been on several sides of this myself, it's always best when you get everybody together in the same room, or in today's world, the same Zoom call. The ideas, the information flow, the assistance that we can provide you as a client is just tremendous when we kind of all are together. And you know, don't look at it like, oh my gosh, you know, is the meter running when I've got this many of my advisors in a room? It's not always that, you know, that the meter's running. We come up with some great ideas to make more money for our clients in that way, make things more efficient. Again, the information flow is better. And plus, it's just a heck of a lot more fun just to get everybody's different perspective and all of that. So I would remind you, if we're not doing our job to get all these folks together, please remind all of us, because we, you know, I think we can provide more value when we do this. So that's all I've got. If you've got any questions, speak up or post them in the chat. And if not, we'll get going with Dave and Jack to give us a surety update. And then after that, we'll have a quick break for everybody to refresh their coffee, and we'll get going. So with that, we'll pass it over to Dave, and look forward to hearing what he and Jack have to say.
Thanks, Doug. Hey, good morning, everyone, and happy Friday. I know everyone's looking forward to the weekend, I'm sure as much as I am. But we are very glad that you're able to take some time and join us today. Also, before I start, certainly like to thank Doug Hauser and his team at Ray for partnering with us at Overmyer Hall. You know, to put events like this together, it's a lot of fun, and they're a lot of fun to work with. So thanks a lot, Doug. Next slide. So like I've done in the past couple of years, I'm going to share some thoughts on the previous year and then provide an outlook on the for the construction and surety industries for 2021. And if that is not exciting enough, we have the one and only Jack Kehl with us today, who will also be providing some tips on how to bulletproof your bonding program. So looking forward to that. 2020 was certainly an unprecedented year. Some might say it was a bit of a dumpster fire. But if you're in the construction industry, you're probably saying that it really wasn't that bad. Actually, you might be saying that it was pretty good. Obviously, COVID and then the government's response to COVID created a lot of uncertainty in the business environment, and uncertainty is very bad for business. But it's almost been a year since the first COVID shutdowns occurred or were implemented. And so what have we learned? For starters, the construction industry really proved to be incredibly adaptable. Doug hit on some of that. Despite changing conditions, the PPE requirements, production delays, supply chain issues, job cancellations and postponements, and really managing through that PPP process, many contractors really actually had a really positive year from a financial standpoint, and some contractors that we thought had a record year. So it really didn't turn out to be that bad. Construction spending was down, but not to the extent that everyone feared. One key to success or to this success in 2020 was really that the contractors as a whole carried a really strong amount of backlog into 2020. And that really helped contractors get through that tough spring. But we'll talk about more about that in a minute. Go ahead, next slide. So Doug hit on that there is a really divided forecast. Analysts are very split, it seems like, at least in my research, as to what the construction industry is going to look like in 2021. We're still dealing with a lot of uncertainty, and the dividedness is really split into a couple of camps. In one camp, 2021 is going to be another positive year. We're going to see growth, but perhaps the first half of 2021 will be slow with a really positive second half. And then the other camp is that 2021 is going to be a struggle. It's going to be a down year. Public budgets are a mess, and the private market is going to struggle. But then a recovery is going to happen in 2022. So those are kind of the two camps that I've seen. Here is a chart from FMI, and it's a little bit different than the construction analytics chart that Doug showed there briefly, where FMI is kind of in that camp where 21 is going to be a struggle for most segments. They're even forecasting kind of a down year for residential construction. Non-residential buildings also a bit of a decline, and then non-residential or non-building structures, it looks like it's going to be more flat. So it is interesting that FMI again shows the recovery in 2022 of all three segments, but certainly not hitting back to that 2019 peak anytime soon. So again, the construction construction analytics group are in that camp where 2021 will be a year of growth, especially compared to what 2020 brought us. So let's take a look at another indicator that might help us out to determine what next year is going to look like.
Hey, Dave and Jack, we got a question here before you get into this slide. How are sureties viewing companies who may have been hit or focused more on some of the COVID impacted segments? Is the surety industry really taking a deep dive into what their particular segment is and how they might have been more impacted? Are you seeing that kind of bifurcation at all?
Certainly, some segments have been impacted by COVID more than others, and sureties are certainly taking a closer look at those and asking more questions, trying to understand if it was simply a COVID related problem, or if it's a deeper problem, for that either industry or for that construction company. Would you disagree, Jack?
No, not at all. I think if you're that one trick pony that's focused on a retail segment or the hospitality industry, you are definitely under the microscope. And they want to hear, what is your plan going forward? Obviously, these segments are crippled and not going to be productive areas for your time. So what are you doing? How are you morphing yourself into something different? Or how are you reducing the footprint that you have in order to survive? And they want to know what that plan is. So you better have one.
Good point. Yeah, if you're in one of those segments, or even if you've just been hurt by postponed jobs, knowing your plan and communicating that plan to your team of professionals is going to be key in 2021. So here is another indicator that we like to look at. It's the ABI, or Architecture Billings Index. I thought this was interesting to share because, as many of you may know, a score over 50 means that architecture billings are growing. And the only segment or region of the country that is growing at least a little bit is the Midwest. And the Midwest, you can barely see the yellow line there on the line chart, but the Midwest is also the only region that grew from October to November. So it points to good things for the Midwest. Again, our Architecture Billings Index is when the architecture billings are increasing, and so what that translates to is hopefully more future work coming down the pipe. So here's another important indicator that I've grown to really like and look at regularly, is the ABC Construction Backlog Indicator and Construction Confidence Index. Again, getting back to backlog, as I mentioned, backlog was incredibly important going into 2020. That strong backlog helped contractors not only to survive, but to thrive. And unfortunately, as you see in the chart here, the indicator dropped sharply in December of 2020 as compared to December of 2019. I believe that represents something like a 20-25% drop from just 1 year. And so as we head into 21, does that point to possible struggle for some contractors, at least in the beginning part of the year, before they can add to that backlog? Lower backlogs, in addition to the uncertainty of available work, has certainly caused bidders list to grow. I've seen as many as 10 or 15, if not more, on some projects. So competition is very high for the work that is out there. And this may be putting downward pressure on profit margins. So this is certainly something to keep an eye on. However, it is an interesting point to make that the sales confidence, the confidence that sales will be growing in 21, is actually rising. So although backlog is down right now across the industry, there is a consensus that 21, or at least an optimism that that 21 will be a better year. So this is similar data from the ABC, but it's just numerical. And from here, it breaks it down by industry, region, and company size. And I'll just comment on this briefly, but it is interesting just to note that heavy industrial as an industry, the West as a region, and the larger companies over 100 million in sales, are the ones who, I guess, have seen backlogs drop the most. So just an interesting comment there. So that brings us to our poll question. Just a quick poll. Do you expect your backlog to either increase significantly, increase slightly, stay the same, decrease slightly, or decrease significantly in 2021?
And Dave and Jack, while we give folks a few seconds to vote and see the results, it will be interesting. I don't know what you guys see, but from the discussions I've had across my client and prospect base, I would vote, if I had one here, in the increase slightly category overall. What do you guys think?
It's interesting, Doug, because it's very different depending on where you're at in the state and the size company that you are. If you're focused on larger projects, 50 million and up, I think you're expecting some significant increases. If you're focused on the smaller projects, it's going to be, a little different story for you.
Yeah, excellent point.
Yeah, so here are the results. Certainly a lot of optimism. Either at least 70%, 75% that think that their backlog is either going to stay the same or improve. I'm not really surprised by that because of what information I've been able to gather, at least in regards to Ohio specifically. So transitioning from the national kind of macro outlook to some of the information that we have for just Ohio. Ohio seems to be in a much better position than the national picture, or at least from a forecasting standpoint. Here's some graphs, charts from Construct Connect, which is similar to a Dodge type service. And what we see here is the non-residential commercial construction starts. So this is going to be construction that is put in place starting in 2021 and beyond. And it's interesting to see that offices, shopping, and even hotels and libraries are actually increasing, at least at a modest pace. So again, Ohio in this regard seems to be in a little bit better of a position. Here's medical construction starts. Man, the medical market really peaked in 2017, or 2016, 17, and 18. 19 was down quite a bit, but it's definitely leveling off over the next few years, and that's pretty consistent to what I'm hearing from our contractor clients. Mm-hmm. Next slide. Civil construction starts. This is really interesting to me. With budget constraints, gas tax here in Ohio, down about 10% from what they expected. There seems to be a large amount of flattening. However, the road construction, the purple line there, is headed for some significant growth, at least compared to other segments. So that could be a bright spot. Education has certainly been up and down over the years. FCC has stopped funding of some new schools in 2020, and they will likely continue to halt that funding through at least the first 6 months of 21, from what I'm hearing. But there are some ELP projects in the works, And what we're seeing is a small increase in high school and university work, where elementary work put in place is going to be down a little bit.
You know, Dave, that
Next.
the other thing that we see in that school space is the project size keeps increasing. So where those schools used to be, $10 million projects, 100, 200, $300 million school projects are starting to be a little more normal. And that eliminates quite a few bidders. So interesting trend.
Absolutely. And big risk there for some of those large, general contractors or CMs that are doing that work, as well as for the sureties, is that subcontractor risk. So there's a lot of attention on subs on those jobs.
Mm-hmm.
So moving forward, 2020 for the surety industry was very much the same. There was a lot of fear in the beginning. Surety companies were very fearful that all of this COVID stuff would result in mass work stoppage and create a lot of claims and losses for the surety industry. But in reality, those fears never came to fruition. They largely did not materialize. In fact, from what I hear, there's claim departments in some surety companies that were eerily quiet. And it turns out that contractors and owners really got along well, really shared in some of these issues that were happening, and got through the worst of it together. But as you look at the table, this table shows results of the surety industry through September of 2020. And typically a surety company is going to need to reduce or keep losses below 40% in order to be profitable. And here I've highlighted quite a few that are approaching or over 40%. And were these losses due to COVID? And largely the answer is no. COVID really has not had a dramatic effect on the surety industry or their results. However, we are seeing some severity claims. Severity meaning fewer claims but larger claims. As Jack pointed, just to schools, some projects are increasing in size, increasing in complexity, and some of the underwriting decisions and some of the loose underwriting that was going on in 18 and 19 have appeared to result in some large losses for some of these insurance companies. And so what does that mean for you as a contractor? Well, frequency is one thing. Lots of small claims, they can be dealt with. Severity claims absolutely get people's attention. And so it's going to naturally make the surety companies react with some possible re-underwriting or looking at certain segments of their business to see what went wrong and are there ways to fix it. Can you skip to the next slide? So will we see credit tightening? Maybe a little bit, but there is a lot of capacity in the marketplace. And so none of these severe losses that we've seen across the country have really had a dramatic impact on these surety companies. No one is going out of business. That capacity is still there. They're being absorbed. However, the underwriting piece could be changing, has changed some already. There are some segments, especially it seems like smaller contractors where surety companies are re-underwriting some books of business. But the focus for 21 is really going to be on these key items: backlog, AR collection, liquidity, supply chain, contract provisions, and labor. One of the hot buttons is AR collection. Sureties want to know, are you getting paid, and are you getting paid timely? So I believe that leads us into the next polling question. So I'd be curious to know if you feel that the collection of accounts receivable in 21 will be either much slower, a little slower, about the same, maybe a little bit better, or much better.
Yeah, Dave and Jack, I'll be curious to see what the audience thinks on this. I can tell you that, beyond the surety market too, from a financing perspective, that, this is always, either 1 or 1A for bankers in terms of what they look at. And again, there's a lot of credit available, a lot of liquidity available, as you said, both in surety and financing, but this is something really that folks pay attention to. So you need to be on your A game as an owner in terms of your collections, for sure.
Well, and it speaks to two things, Doug. It speaks to the firm itself, the construction company itself, its processes, and how on the ball they are as far as collecting. But it also speaks to the quality of the owners they work for. And I think that's one area to really focus on in 21, is work for quality owners, people who know the game and are going to pay you.
Yeah, so not surprising to see that expectations are that receivables are going to be a little bit slower. I have heard personally of some owners switching in the middle of a job from 60-day pay to 90-day pay or 120-day pay. I mean, obviously that doesn't happen on most public projects, but those kind of things are happening, and certainly something to pay attention to.
Well,
last slide
for this too, Dave, that whenever there's uncertainty, what's the natural response, right? It's to hoard cash, right? Hang on to things in times of uncertainty, and we definitely have a lot of uncertainty right now.
Yep. So just the last slide to leave you with some potential impacts for 21, both positive and negative. Obviously, a federal infrastructure plan would be a huge positive for the industry. COVID vaccine is going to help. The return of some postponed work is certainly happening, and the pent-up demand, it does seem like the second half of the year is going to be strong with some of this demand coming through. On the negative side, labor is still tight. There is some material inflation happening with steel and lumber. So a spike in COVID cases would certainly cause more uncertainty and possibly a stronger response from the government. Interest rate increases, although it's probably unlikely, at least in the certainly the first half of the year and perhaps in the next year. But public budget cutbacks is certainly a reality and may not be fixed for a couple of years. So with that, Jack, how are we going to bulletproof our bonding program?
Yeah, I love it. I love this picture. Superman's a cool dude. Always admired the guy, right? But for our contractor friends, you're all kind of wanting to roll into 2021 and feel like Superman, right? You want to be bulletproof, right? And so we've put together just 4 simple points together with some great visuals just to help you kind of remember to keep these things in mind as you move forward. Next slide. So I think we'd all agree with this statement. 2021 was just, it was unreal, right? It seems like a dream now. And 2021 is uncertain, and things keep flipping back and forth. Frankly, I feel a lot more optimistic today than I did, 3 weeks ago. So things are changing. But one of the things that I'm actually seeing is this increased scrutiny from creditors. Even though there's a lot of money supply, interest rates are low, those are great things. But we saw banks rethinking their construction risks, specifically contractors. Dave, I think it's 3 or 4 banks we saw exit a lot of the contractors that we work with. Actually, to my surprise, I'm like, why would they do that? This is a healthy contractor. So for whatever reasons, we've seen some shifting there. as Dave pointed out, the loss ratios are kind of on the rise with some of the surety companies, not necessarily related to COVID, but a host of other issues. And so sureties are kind of a little timid right now. We're seeing that. One of the things I think is we're going to see increased public spending from the feds, which is great. The Biden administration has made no bones about it. They're going to spend money, right? And there's no better way to put money into the economy and get things rolling than in construction spending. So this infrastructure bill's been beaten around. Everybody agrees we need an infrastructure spending bill, and it'll be large, it'll be comprehensive, and I think it'll be early in his administration, so that'll be great. We're seeing spending on government building, military bases, green projects. They have made absolutely no question that green spending is going to happen. And as a result, the other thing we see are these increased job sizes. I am astounded at the size of projects that I see almost every day. It's like, really? Well, wow, right? Well, anytime you increase the size of a project, you increase your risk, right? And it's all about risk. And you've got to keep that in mind, because it's easy to kind of take on more and more risk without feeling it. It doesn't feel like I took on more risk, but you are. And it's a financial risk. Next slide. Number one rule, and it's self-serving, of course. Notice that's a jack. So, jack of all trades. You can't do business with a jack of all trades when it comes to surety. The guy who's out there selling business insurance on Monday and Tuesday and health insurance on Wednesday and maybe sells a life policy Thursday and, oh, maybe Friday I'll write a bond. That guy's going to lead you down the wrong path. He's not going to have the respect with the surety companies. He's not going to have the knowledge to keep you from making a mistake. And it's easy to do in times like this when things are changing and uncertain and you're trying to step up into larger work programs. These guys are order takers. They're a conduit. They're carrying information, and there's frictional loss between the surety company and you. What you've got to work with is somebody who understands how the surety is going to think and react and prepare you ahead of time for that. They need to have multiple surety relationships. They need to be dealing with a significant amount of surety premium, because let's face it, that premium is leverage with those surety companies. And that's what you need to make those transitions a lot of times, is that leverage. So surety focused contractors need to be dealing with a surety agent, a professional surety agent. So that's your number one tip right there. Next slide. Number two, make every contact with your surety count, right? When you're connecting with the surety,
Jack,
whether it's by, yeah.
Sorry, we got a question that I thought was pertinent while you were talking about this and dealing with the right agent.
Yeah.
What about looking at contract provisions? I mean, obviously that's something you guys dig into, and maybe somebody who's quote unquote part-time isn't as well versed in that. What are you looking for in particular when you look at contract provisions? Any particular themes there?
What we're really looking for is the same thing that any contractor is going to be looking for: the anomaly, right? Where's the weird provision? What are they trying to get at here? Whether it's related to payment terms or consequential damages, the emphasis on force majeure has been ridiculous here of late, but it's that anomaly. What's going on here? That's really what we're kind of focused in on. And obviously, the chief concern is always payment, right? Payment. When are you going to get paid? How are you going to get paid? That's really where we're going to focus in when it comes to the contract provisions and the penalties, right? Liquidated damages. we've seen those numbers really increase. I'm astounded at some of the ones I've seen. And that's what I mean about that risk. That risk is really jumping up there.
Well, that's the additional value you guys provide, that additional professional set of eyes there.
Yeah, just having an understanding of what these things are and being able to read the contract. But back to this point here, when you're connecting with the surety company, and I see this happen all too often, whether it's a meeting, whether it's a Zoom meeting, a conference call, or just pushing information back and forth, make it count, right? You want to deliver a knockout. You don't want to be average or subpar. Anyone can show up for a meeting, right? It's how you prepare that counts, right? So, ask for an agenda. Understand, what is this meeting about? Right? Add to the agenda. Create your own agenda that includes that agenda. Ask questions before they ask the question and answer it. Right? Use your job costing software, your KPIs, pictures, whatever. Throw it up on the screen and walk the underwriters through it. Right? Give them complete information. Too many times, I find contractors in a situation where they're totally not underprepared because they didn't take the encounter seriously. So one of the greatest examples is Rocky 3, right? Remember that movie where Rocky steps into the ring and he's thinking he's there for a publicity stunt, and he encounters Hulk Hogan, who's Thunder Lips. I mean, it was great. He breaks him in two, right? Why? Because he wasn't prepared for the encounter, right? Make sure you prepare yourself. So remember that image. You don't want to be that guy, right? Next slide. Number 3, it's not all about income. Right? It's what you retain in the business that counts. So you guys might remember this guy, right? Scrooge McDuck, right? The guy kept every nickel he ever made, right? He had so much money he would swim in it. That's what the surety would really love to see in every business. Now, we know that's not going to be practical in every case, but too many times sureties will watch your company succeed and grow in income throughout the year, and then at 12/31, all the money magically disappears, whether it's in distributions or bonuses or what have you. They want to be able to rely on the balance sheet side of the equation. That's what they really rely on in establishing those levels of support for you. And why is that? Hit the next slide. Because cash is what you need when everything hits the fan, right? The one thing that's going to fix problems is cash. So 9 times out of 10, you need that cash, and you need it now, right? It takes too long to raise capital, to jockey things around. And time is everything in these emergency type situations, right? That's why the surety is so focused on that balance sheet, right? So you focus on the balance sheet. Next slide. When you do have bad news, right? Deliver the bad news as quickly as you can, but don't do it foolishly. In other words, raising your hand and saying, hey, we just lost $1 million, that's not going to help anybody, right? You need to understand what happened. We just lost $1 million. Here's why we lost $1 million. Here's what we're doing to correct the problem. The machine is already engaged, right? Get your ducks in a row and deliver the information, deliver the message, deliver the solution, right? If a job's going to lose this $1 million, it's more important to know what happened and how you intend to fix it, rather than it was 900,000 or $1,000,001. Right? It's speed. Identify the problem, quantify the problem, communicate a solution. That's how you deliver that information. Don't sit on it and surprise them 5 months from now or 2 months from now. That'll totally erode the trust that they have in you. And trust is everything in this business. So I think if you remember those 4 points and kind of put those 4 visuals in your mind, it's going to help you develop that bonding program and help you be a little bit more like Superman and bulletproof yourself. So thank you. Appreciate the time this morning.
All right, at this time, we are going to have a few minutes and take a break. Feel free to refill your coffee, stretch your legs, and we will be right back. You might hear some chatter as we go through questions, as we kind of discuss what we've heard so far. Doug will probably take the lead on that, but in the meantime, just take a break. Thanks.
It was right on time.
Just a reminder, we are on just a short break to allow you to refill your coffee cups and stretch your legs, use the restroom. We will be back live with Scott here at 9:05. So just a few more minutes to go. Thank you.
All right, we're just about back here, and it's 9:05, so we'll get Scott going. Hopefully everybody got a chance to grab a little coffee or caffeine. No offense to the tax guy, right, Scott?
Need plenty of coffee before the tax presentation.
All right, we'll get going here. Scott's going to go 30 minutes and run through a tax update.
Good morning, everyone. Great to have you this morning. As others have mentioned previously, we definitely wish we could do this in person, but great to be able to put this together virtually. Want to thank the team over at Overmyer Hall. It's great to work with Jack and Dave and Joe, as well as the other members of the team over there and partner on this, and look forward to presenting you with some information that we are seeing out in the market, both with our clients and prospects. To start with the agenda, I'm going to hit on the recent legislation that was passed right at the end of the year, and hit on a few of the items as it relates to PPP, how that impacts the tax situation, also hit on some tax relief and extenders. I'm going to provide an overview on these. Many of these topics warrant a full webinar themselves, which we have hosted some and will be hosting more, but definitely want to hit on some of the items and how they're impacting the construction industry. Next, hit on some of the remaining items that came about in the CARES Act back in March of 2020, and some of the opportunities that it presented, and some planning considerations. And then we'll get into some of the highlights of the Biden tax plan as we know it today, and hit on some of the considerations under the current political climate. And lastly, in the construction world, we are always focused as well on the state and local tax considerations, so have some items there that we want to hit on. So next slide. So starting here with the recent CAA bill that was passed and signed into law on December 27th of 2020, it addressed the question that we had with many people as we were looking at year-end planning of how the PPP loan would be treated for tax purposes. So initially, they made it clear that any forgiveness of the PPP loan was not going to be considered income for the tax situation, but the IRS quickly had followed up and noted that though that was not taxable, the related expenses covered by that PPP loan would not be deductible. There was a lot of negotiation that went into that, but the good news is at the end of the year through this bill, it was passed that those expenses are now deductible. So really kind of a push for the tax from the tax standpoint, and no impact on taxable income for 2020. So that was great news because obviously many companies in the industry received sizable PPP funds, and to pay tax on that was not something that they were looking to do or expecting to do. And good news is that that has gone away. That's effective as of the date of the CARES Act, which brought on the PPP, like I said, back in March. It also applies to the second draw PPP loans that I'll hit on here shortly. Great news for the construction industry, as I mentioned already, from the taxable income standpoint, but also at year end, there was a lot of consideration within the practitioners of how it would impact percentage of completion calculations and WIP schedules, along with would it impact the wages eligible for any of the qualified business income deduction under 199A. So those considerations have all gone away now that it is clear that those items do not impact taxable income. One other piece to note is the forgiveness for the loans that were under 150,000. This simplified that process and streamlined it. A new form was actually issued this week by the SBA and helps with that process being a lot more simplified than it originally was set up. So that was good news as well. Next slide. So as I mentioned, there also is the PPP 2.0 that came about with the recent legislation. It's bringing up about another $284 billion available under PPP. This go around, it is designed for the hardest hit businesses and industries. As we have talked in the prior sessions, the construction industry has not taken the hit that many others have, and we are seeing solid results for 2020, but obviously there are industries that have taken a big hit, and that is what this round of PPP is designed for. With that being said, it's designed for companies with 300 or fewer employees that have experienced a 25% decline in gross receipts in any quarter in 2020 compared to the same quarter in 2019. So as I noted, you have to show that there was a decline in your business, and frankly, we are not seeing a lot of that would qualify in the construction industry. Just to note some of the items that are factored into the gross receipts component of that, PPP and any EIDL funds that were received earlier are not included in the gross receipts related to those calculations. It's based on calendar year quarters, and also to be eligible for the PPP 2.0, you have to have used the entire amount of your first draw funds or the first PPP. So the PPP is definitely one of the areas that there's a lot of detail and a lot of considerations. And as I said, our firm has had several webinars on it, and I'm not going to get into all of the details today, but just wanted to hit on some of the highlights. Next slide. With the 2.0, the maximum loan amount here is $2 million. It is based off of the same 2.5 times of average monthly payroll cost as the first go around was, except there is a provision for folks in the hospitality industry, restaurants, hotels, etc., to calculate that based on 3.5 times the wages. So if there's any of you out there that didn't view construction as a high risk or enough risk in your business operations and have gotten into the restaurant industry as well, there is a little bit more of an upside on that for the PPP. This is just covering some of the additional considerations as it relates to the periods of time that you calculate the payroll costs, and then also the covered period. The borrower can choose any period between the 8 and 24 weeks. If you remember, the first PPP was based on an 8-week covered period, and then it eventually was extended out to a 24-week period. So this one kind of follows suit with that and allows you to utilize any spread in between there. And generally, the documentation is the same as the first draw PPP. As we've talked all along with PPP, you have to have the necessity for the loan and be able to document that. So that's one of the considerations as well. Next slide. on that note, you have to certify that you're not receiving another second draw through some other source. You have to prove the reduction in the gross receipts to qualify for that. As noted before, you have to fully utilize any of your first draw amounts and eligible expenses. And like I said, the loan necessity is really a big consideration in this go around, because it is designed for the industries that were hit the hardest, and will receive some additional scrutiny from the banks and the SBA on that front. Next slide. So also within the recent legislation, there were several tax items as it related to both business and individuals, as well as some extenders. So one of the items that it introduced is a temporary 100% deduction for business meal, food, and beverage expenses, but not entertainment expenses. So if you remember in the Tax Cuts and Jobs Act back under President Trump, there was a lot of changes related to business meals, entertainment, and so forth. And it ended up with those meals would be 50% deductible, and now those will be 100% for 2021 and 2022, but entertainment expenses still will not be deductible. It also extended the employee retention credit through June 30th of 2021 and added some enhancements. This is another topic that warrants a full webinar itself. But generally speaking, in a situation where in 2020 you had a 50% decrease in your gross receipts versus the same period in 2019, you could qualify. Or if you were in an industry that was shut down by government order, there were some qualifications there where you could get a credit of up to $5,000 per employee. That has now been extended into 2021 through June 30th, and provides the opportunity to now get up to $7,000 per employee per quarter. So in 2021, you could get up to $14,000 if you qualify. And they also lowered the threshold of the decline in gross receipts to a 20% factor. So lots to consider in that calculation, but definitely wanted to hit on it. Also, originally, the ERC was not available for anybody that had received PPP funds. That is no longer true. So there is an opportunity for anybody that qualifies to go back and capture some of those credits from previous. Also extends through March 31st a refundable payroll tax credit. Next slide. So on the individual side, this is where the most recent stimulus payments that went out to individuals that qualified, $600 for individuals and dependents. Currently, President Biden has a proposal that includes a third round of stimulus payments that would be an additional $1,400 per person. As this bill was going through the final process, there was a lot of debate on could they get it up to $2,000 for each individual. It ended up going through at the $600, but there's still a lot of consideration that a third round would come out to get to that $2,000 per person. It extends the opportunity for folks that do not itemize to take an above the line deduction for charitable deductions of up to $300. It also extended the deferral tax payment that came about with the August executive order for deferred withholdings on your payroll. Originally, that was scheduled to be required to be paid back by April 30th of 2021, but it is now extended through the end of 2021. Also, lastly, it issued some special rules for rollover of health and dependent flexible spending accounts. Traditionally, those are a use it or lose it consideration before year end, and now it provides the opportunity to roll those over for 2020 and 2021. Next slide. So part of the legislation also created some extenders. Extenders are items that every year come into play depending on when they are set to expire, when these provisions are originally put into place. It seems like an annual thing of debating which ones are going to go through and when. Typically, it seems like they wait till the end of the year to let us know what the rules are for that year. So just to highlight here, these extenders that went through, some of them are permanent, some of them are set for 5 years, and lastly, some of them have varying expiration dates. But the permanent ones that have been put in place now, and when I say permanent in the tax world, you never know exactly what that means, but as it currently stands, a couple of the key ones there is it lowers the adjusted gross income threshold for medical expenses to 7.5% instead of the 10% that it increased up to. So that plays into the individual situation when you're itemizing. One of the other key ones there, I guess I'll point out, is the lower excise tax rates for small brewers, distillers. Obviously, 2020 increased a lot of the activity in the alcohol and liquor worlds, and it was good news that they were able to extend those lower excise tax rates for those businesses. From the construction standpoint, the energy efficient commercial buildings provisions under Section 179D were extended permanently. This comes into play a lot with contractors who are performing projects for government entities. Those government entities do not receive the benefit of the related deductions, and through a process they can pass those along to the contractor themselves. So it's just something I wanted to highlight that's extended permanently. Next slide. Here I've listed some of the 5-year extenders. It's not the full list, but some of the key ones there I would say would be the work opportunity tax credit. It is big for employers that qualify for that with their employee base. It's also extended the empowerment zone tax incentives and some other provisions there. I think the main thing on this 5-year extender to highlight is that this sets these items to expire at the end of 2025. That layers on the same consideration as many of the Trump tax cuts that came about under the Tax Cut and Jobs Act, based on how they were passed, have a sunset of 2025 as well. So as we look forward into towards the end of the current administration and the next election, this will be a hot topic in consideration because there's a lot that will be scheduled to expire in that first year of the next go around. Next slide. So this is kind of a list of the remaining items that were extended that have varying year or expirations to them. As you can see, there's several there that relate to energy considerations, renewable fuels, so forth. So just wanted to provide those, but won't spend much time there. Next slide. So that is an overview of the most recent tax legislation components, but wanted to bring up some considerations that came about from the CARES Act back in March, that are considerations that we're looking at with all of our clients. And one of the things that went away under the Tax Cut and Jobs Act was the opportunity to carry back any net operating losses. This was a big discussion point in the construction industry when the Tax Cut and Jobs Act went through, because we were thinking back to when a recession happens, a lot of times those carrybacks provide tax refunds that help with the cash considerations and cash flow challenges in downturn for the construction industry. So those had gone away, but the CARES Act brings those back and allows you to do that currently. So something that even when businesses are performing strong from a financial statement purposes, they're with all of the accelerated depreciation considerations that are available, you can create some losses there and would be a consideration that we would want to look at in certain situations. Along the same lines is the Tax Cut and Jobs Act created a business loss limitation of only $500,000 coming through from pass-throughs on individual returns, and that has now been waived. So there could be some opportunities of even looking back in prior years and for those and taking advantages of losses if those did occur in prior years and you were limited. Next slide. Some other items that came about in the CARES Act that impacted rules from the TCJA. It provides some additional interest expense allowance under 163J. That's a situation where it limits the interest deductible for tax purposes. So it's provided some opportunity there. And then it corrected the legislative error that came about in the Tax Cut and Jobs Act related to qualified improvement property. Under that act, it defaulted to a 39-year depreciation and was not eligible for bonus depreciation. But they have made that change and made that retroactive to 2018 and 2019. So there's some opportunities if you had those qualifying costs to go back and get those. Next slide. Next slide.
I apologize. There was a little glitch. I'm working on fixing it right now.
Okay. So I think the next slide related to bonus depreciation. It's a big topic in the industry that comes up, and it is currently the 100% of bonus depreciation that allows you to write those items off in the first year. And I just highlighted here because that is set to sunset and phase out over the next several years, and is a common question as we're talking with clients and prospects and they're looking at their depreciation situation. So just wanted to provide that. So next slide, get into some of the considerations as it relates to the Biden tax plan. Obviously, this is proposals that were provided throughout the election process. There's lots of questions and maybe not all of the details, but wanted to hit on some of the highlights that we're seeing there. And one of the things is from the corporate tax rate standpoint is increasing that up to a flat 28% from the current 21%. This would be for C Corps. If you remember correctly, or if you remember, this was lowered down from 35% on a graduated tax rate schedule or bracket previously. So it's kind of a in between for C Corps. Also proposed to impact individuals on a variety of items as it relates to any individual that has income greater than 400,000. This proposal is where there's quite a few questions, but that 400,000 is a consistent number throughout several provisions and is up from the $250,000 that was in similar provisions back under the Obama and Biden administration. So there is some increase there, but talk of increase of the top rate from 37% currently to 39.6. Also phasing out the pass-through deduction under 199A if your income is over 400, and raise capital gain rates up to 39.6% for income over $1 million. So that's a significant increase over the current 20% rate that also would be eligible or subject to the 3.8% surtax on net investment income. But that almost doubles for those with income over $1 million. It also imposes, the proposal would also impose a 12.4% Social Security payroll tax on incomes over 400,000. So if you think currently the Social Security wage limit for 2021 is 142,800, and when somebody's payroll reaches that point, it stops withholding for Social Security, but this provision would kick that back in at the 400,000 bracket or level. Next slide. So here I just wanted to provide kind of the different rates under the old law, under the Tax Cut and Jobs Act, that are the current provisions, and then President Biden's plans of the different rates. The interesting thing is that 400,000 threshold that he's used across the board actually currently falls in the 32% bracket under the current tax bracket. So it's not clear how the logistics or the impact of that would come through. Also to highlight is, yes, the top rate currently is 37%, but for those that have qualified business income on pass-through income on their tax return, the effective rate that currently is being paid is 29.6%. So if you have that and the proposal goes up to 39.6, obviously there's a 10% increase in the rates there. So just something to be aware of, and obviously we'll continue to monitor. Next slide. Here are some other items. For time's sake, I'll probably kind of just skip over those, but some items that also are part of President Biden's tax plan. Next slide. Here, there's some changes also proposed as it relates to the tax deductions and itemized. Inheritance tax is one that's a big deal as it relates to his proposal. And it is the change that he proposes, that the step up in basis rules that currently apply to inherited assets would go away. That's a significant change because current tax savings on appreciated assets occur. And sorry, I have a screen here. Sorry, there's a change on my screen here. I hope you can still hear me.
Yes, we can still hear you.
Okay, so there's significant change as it relates to the inheritance tax, and does away with that step up in basis that currently happens, and would lead to your basis in those items being what it was in the hands of the prior owner or the deceased person, which would definitely change the tax impact and the related record keeping. So something to keep an eye on that standpoint. And then the estate tax hitting there on the reduction of the proposed reduction as it relates to the estate tax threshold that's currently 11.7 million would drop back to 3.5 million under President Biden's proposal. So another item to be aware of, and would be a whole nother topic for a whole nother webinar. Next slide. So the question here is, what's the likelihood of tax changes happening? And so I wanted to highlight the current situation as a result of the election. With the Georgia runoff that occurred at the beginning of January, the Senate ended up in a 50-50 split between the Republicans and Democrats, and Vice President Harris would break any of those ties. So that is key to any tax legislation, and kind of the votes that would relate to that. It also provides the opportunity to use the budget reconciliation process for passing bills when the same party controls the White House, the House of Representatives, and the Senate. So next slide. So what that allows for is, instead of the standard 60 votes for passage, it instead requires only a majority of 51 votes. And that can be reached with, like I said, the tiebreaker under the vice president. And the budget reconciliation can only be used for impacting revenue or spending bills, and tax bills fall under that. I highlighted there many of the recent tax law changes were passed using this tool back in 01, 03, 2010, 2017. So it's something that allows for that to maybe move through the process sooner than later. And with the midterm elections in a couple years, there's probably going to be some consideration as it relates to balancing the current COVID economy concerns and a push for the tax changes that I just highlighted. So something to definitely be aware of and keep an eye on. Under the budget reconciliation, it generally tends to partisan provisions happening. And so anytime there's a flip in the administration, it leads to a lot of the changes and considerations that we're currently facing. So here I have some state and local tax considerations. Just quickly want to hit on those. The main focus or consideration here is, just because the federal tax treatment shows that PPP or some of the other incentives received may not be taxable at the federal level, does not mean that they won't have some impact at the state level. So that can vary from state to state. One of the incentives that we are seeing here in Ohio that is a big topic right now is the recent Ohio Bureau of Workers' Comp rebates and dividends. Ohio's position currently is that those would be considered gross receipts taxable for Ohio CAT purposes. And so that's something that, with the size of those workers' comp rebates that happened at year end, it's a consideration to be aware of as it relates to your CAT filings that would be due here in early February. So something I want to hit on and could elaborate with any questions later that somebody may have. So sorry that I've had to move through these slides pretty quickly. I wanted to hit on a lot of these items. And obviously I'm available for any follow-up questions. Now I will pass it over to Joe Urquhart, and we'll go from there.
Thanks, Scott. We will finish up the presentation with all this fun insurance stuff. I know everybody was staying on just to hear this. So jumping right into it. I started off with this slide. I had this last year. I said, are we in a hard market? So I tweaked it a little bit. Are we still in a hard market? And is it really a hard market? That's what we'll take a look at. Is it a hard market, or is it maybe just an adjusting market is really the question. So just a quick agenda. We'll briefly take a look at last year, and you'll notice I named it the year that must not be named. I think we're all looking forward just to turning the page and looking ahead to hopefully some better times and more normal times. And then really the main point of my presentation is just taking a look at the insurance outlook. How do rates look, coverage look for next year? What should be on your agenda from a risk and insurance standpoint? And again, we'll look at some tips and some of those insurance issues. So just a quick review, right? What kind of year did we have? It was a little bit of a crazy year, I think, in insurance. And I don't think it was technically a hard market, possibly for some. If you're in a trucking industry, it was definitely difficult. Certain industries within construction, I think, got hit maybe with some bigger increases where it needed to make some changes. But for most of the construction world, it was more just of an adjustment time. Particularly in auto, as you probably all went through your renewals last year, larger fleets tended to get hit a little bit more. And again, insurance companies were looking at basically the size of your fleet, meaning one, number of vehicles clearly, but more what type of units you had. You had a lot of heavy, extra heavy, and those were targeted a little bit more. And radius also. If you're having trucks that were going particularly far, you got hit with more. Umbrella is a bigger issue. I'm going to talk about that a little bit more as we look to next year. Capacity issues on umbrellas, big issues. If you have a 10 million or more umbrella excess policy, you probably saw some changes last year. You'll see those moving forward, I think, in 21, which we'll talk about. The whole COVID guidelines, how they came in, safety, some of the project delays definitely had some effect on the insurance marketplace, obviously, as well as business shutdowns. The one thing I want to note right here, coverage issues with COVID, particularly having to do with business income. This is an update, and this is really just as of yesterday. I got notification of a very important court case, actually happened here in Ohio. It was the Henderson Road Restaurant Group versus Zurich. So if you get a chance, look this up. It's still kind of fresh. I just learned about it. But a court here in Ohio ruled in favor of an insured, the Henderson Road Restaurant Group, that business income coverage applied for his loss of income due to COVID from the shutdown. That is very not normal across the country. Most insurance companies and court cases have been ruling that is not covered. And this court case and the judge here in Ohio said it was covered. So that could have some real ripple effect. My guess is Zurich is going to appeal that case, but I do not know that. That is something really to watch.
Real quick, obviously
Yes.
that's going to be appealed and everything as you
Yes.
suggested. What's your take on whether that really will fly or not?
When you compare that to court cases across the country and really across the whole globe, most courts, one, all insurance companies pretty much are denying coverage. And court cases, and when it gets to courts, most courts have been ruling in favor of insurance companies. Terminology, the contract doesn't grant coverage. That's how most of it's been going. So this is, again, a little out of step, and it really we just need to watch it. Again, I'm pretty confident, but I don't know if Zurich's going to appeal it. And this is particularly important for the restaurant, hospitality industry, retail industry. Hasn't affected, it won't affect our construction clients probably so much. But if they are involved in any type of, again, businesses that were directly affected by these shutdowns, this is huge. And taking it a step further, if that would actually happen to change the outlook in the industry, where more courts would grant coverage to insureds, definitely have a ripple effect in the insurance industry, because they did not fund for this type of thing, and that would really create some loss ratio problems, I think. So we'll have to wait and see. Something to follow. And that restaurant group, I was not familiar with them. Again, I think they're based here in Ohio, very large. In the article I read, they have many different restaurants under this holding company, but they own 13 Hyde Park restaurants. So that's part of that portfolio. So you're talking significant money probably. So let's take a look really at this coming year, 2021. And these are guesstimates from looking at many different sources of what you might anticipate on your upcoming renewals. And I always like to say these are more of a national type figures. I think we're blessed here in Ohio and Central Ohio. We haven't seen some of the dramatic rate increases that they have in other parts of our country, but still there's some pressure on certain rates. So it's just good to be prepared and benchmark and know what you're looking at, maybe prepare, start to incorporate this in your bids, right? So I'll go through this fairly quickly and highlight certain things though. Property, and this is more if you have a lot of property, if you're a developer, if you own a lot of real estate, habitational, there's a lot of pressure there for rates to go up. Contractors equipment, still pretty competitive marketplace really under contractors equipment, so you shouldn't have a lot of problem unless you've had some loss issues. Now if you're a big a contractor that has a lot of equipment, again, competitive, shouldn't see a lot of issues there. General liability, again, not a lot of problems depending on maybe your class of business. So it's getting underwritten a little bit more. There's certain classes that I think have had some losses. As an example, street and road, there's certainly some pressure there to increase rates. So just watch that. A lot of it just depends on your losses, loss history. If you've had some frequency, certainly some severity, you're going to see a little bit higher end on some type of a rate increase. Auto, again, is still the driver. There's a couple drivers here of underwriting issues. Loss ratio problems in auto is still a problem. Depending on the increase that you may have had last year, it may not be quite as severe this year, but I think underwriters are still going to be looking at getting some rate this year on auto. And particularly, again, if you have some loss ratio problems, you're going to see a higher bump. And if you're in that category of lots of heavy trucks, that is just a big emphasis from underwriters. So I think it might be towards the end of the year, and all this is just guessing at this point, starting to subside a little bit, I think, on some of the increases. But certainly through the first half, I think we'll be seeing some more rate on auto. Builder's risk, very competitive for non-frame projects. So masonry, non-combustible, steel buildings, things of that nature, your big projects, very competitive. Rates are great, I think. We have lots of different places we can go for good builder's risk. Don't see an issue there at all. Frame is certainly, though, a problem. That is not going to go away this year, both from a rate standpoint and capacity standpoint. You just really need to watch this. And when I say capacity, if you're looking at a frame builder's risk that is over $10 million in value, I kind of use that loosely, but if it's over 10 million, so a lot of this multifamily that's going up, rates are going to go up, and the limit, that capacity, narrows your options to get competitive builder's risk proposals. So continue to watch that. Umbrella, again, this is another area with capacity and rate. So we're seeing some rate increase here, but capacity is the issue, where a lot of carriers, if you have a $10 million umbrella or more, it can go down as 5 million and above, but definitely 10 million above. There's just could be some capacity issues where we as brokers, your insurance advisors, may have to go out and get different carriers to provide different limits. And when you do that, those higher limit carriers, you're going to see an increase in price there. Professional, pretty good, 0 to 10%. Depends on what you do, how you do it. For the GCs, CM at risk, and any trade contractors, particularly MEPs that have a professional policy, you might see a little bit of rate change there, but nothing significant. Executive risk, this is one area to definitely look at, where you might see some rate, and that is because of anticipated losses from employment practices liability. Across the country, there's a lot of concern because of COVID about losses, increased frequency in losses for wrongful terminations, discrimination, retaliation, wage and hour violation. There's just a lot of concern with that, and that's driving some of the rate. And then the other thing that is driving rate is cyber liability, if you have it. And I'll talk about this in a little bit, seeing more and more frequency and severity of cyber losses. Workers' comp is really, for many years, that's always been the problem. Nobody wanted to write work comp outside of Ohio. It's kind of changed now. People like to see that. It's pretty competitive right now. So there shouldn't be any issue for contractors that have operations outside of Ohio and have work comp. This chart, just a chart. This came from Business Insurance. Got this just a few days ago, and it's issued through Alera Group. It's just some different numbers, and again, these are national numbers. It's a nice graph though, and if you can see over on the left, exactly what I was talking about on the slide before, where we're seeing the big issues with rate, and capacity. It's going to be umbrella excess, auto, property, and then down the line, not so much GL. So just a good illustration of the different lines of coverage and what we're seeing. Again, I don't think in Central Ohio it's as severe as this. Still pretty competitive, particularly for accounts that are well run, and good loss ratios, good loss control. You're going to see lower increases, or maybe no increases, if you fall in that category. Just some insurance tips, best practices to get ready for your renewal, to put you in a better position to have a favorable renewal. Some of these we talked about last year. They're still very important. So you need to really have a good fleet safety program. Again, auto is a hot button. Auto is a problem because of frequency, severity, and it's not going to change. So when you get ready, you should have this anyway, but it definitely helps on your insurance rates and renewals if you have a good fleet safety program. Not just one that you say you have, but that you actually use and implement. It will benefit you. The distracted driving policy, so critical right now. I won't say this is the only cause, but it is certainly a leading cause of the problems we're seeing in auto losses. Severity, frequency, all comes back to distracted driving. And really, it's just not a distracted driving policy or distracted driving problem. It's a distracted worker, where we're seeing claims on workers' comp. People aren't paying attention because of these phones that they have. So you really need to take proactive approach, and insurance companies are looking for that. I put be proactive with MVRs. This is another area that insurance companies are focusing on, and contractors should also focus on. New hire, current drivers. I added in here, own the process. So for years, many clients, no matter who your insurance advisor is, you have a new hire, you want to hire somebody, you call your insurance provider, insurance advisor, hey, can you run this MVR on this person? We want to make sure they're okay to drive. That's not really acceptable anymore. Insurance companies want to see that you are pulling the MVRs internally. There's many different systems to do that. Sometimes you can get discounts from your insurance company to get those systems, but you should be taking the ownership. You should be pulling those motor vehicle reports, not just once a year. Do spot checks, check them throughout the year. Again, be proactive and watch who's driving your vehicles and making sure they're still qualified to drive. And that ties right into driver eligibility. Insurance companies like to see that you have these guidelines. It's part of your safety manual, that it's clear cut on who's eligible to drive and who's not. And that ties back into those motor vehicle reports. Again, if an insurance company comes out and they make some recommendations to you, please take it serious. Try to respond in writing within the time period that they ask you to, and if at all possible, implement what they're asking you to. It'll be one, it benefits you from a risk standpoint. Hopefully it leads to fewer losses, but it'll also help you with that insurance company on any type of renewal that you have. They are looking for that. They're there to help. And lastly, this is new from last year, and this is kind of a new trend. Many insurance companies are looking for this now, requesting it, and it really will help you, but it's telematics. And again, some insurance companies will offer you discounts on certain systems. I would highly recommend contractors that have larger fleets to look into telematics. It'll help you, it'll make you a safer company, it'll improve your loss history on your auto, and it should help you on your insurance renewals in the future. General liability. Some of these, again, same as last year, got some updates. So important right now to update your subcontract agreement. That is something that you're going to need for your insurance renewal as it comes up. A lot of the underwriters want to see it and update it. You want to make sure it's up to date as far as what you're asking for from form standpoint, terminology, limits. One, it protects your company when you transfer that risk down to subcontractors. You want your subcontract agreement to be proper and up to date. But insurance companies are really looking at that. They want to make sure they're protected for that risk transfer downstream. Again, actually implement a contractual risk transfer program. So when you loss control people come out from the insurance companies, you look like you know what you're doing. Know where your certificates of insurance are, your signed contracts are. Make sure you can demonstrate, yeah, we're checking these certificates when they come in to make sure they match our contract. One, it benefits you. It's risk transfer. You'll make sure you're doing it properly, but it'll also benefit you with the insurance company. Subcontractor pre-qualification is very, very important. Jack talked about that, Jack and Dave. It's just huge to help protect your company from construction defect claims, workmanship claims, subcontractor default. You need to have a good pre-qualification system in place. QC/QA program, very important. We talked about this last year. This has been around for a while now. Just as a reminder, because of the court cases here in Ohio regarding faulty workmanship, the Westfield case from many years ago, most recently a few years ago, the Cincinnati case, you want to make sure you go back and check that you have an endorsement on your GL policy for an occurrence redefined to broaden your coverage for any type of faulty workmanship that's done by particularly subcontractors. And each company has their own endorsement. It's not a standard endorsement, but if you just refer to it as the occurrence redefined general liability endorsement, you'll get what you want. Just can't recommend enough. Make sure you're looking at the owner's contracts or the GC contracts if you're bidding, if you're a subcontractor. We're just seeing a lot of changes in upstream contract risk transfer, right? Whether it be limits, coverages, you really want to make sure you're looking at those to make sure you're putting the price for any additional coverages or limits into your bid. You want to make sure you have the right coverage. Lastly, if you turn the page, Abby, one thing you may want to ask, and this is still relatively new, but we're starting to see communicable disease exclusion be put on policies. Still relatively new, not a lot of insurance companies are doing this yet. It'll be interesting to track this through the year. Is this more commonplace? Is it not? I'm not sure. I think you'll see this more on restaurant type policies. We've seen it on some camps and things like that, but it's something to watch for. This is the actual ISO exclusion. So this is what you may see. There may be other homemade type exclusions from individual insurance companies, but what they're trying to do is exclude coverage for COVID is what they're doing. Just something to look for. So again, just a couple things moving forward is auto. I'm not going to talk too much more about that, beat that one. You got to focus on auto for many reasons. Cyber liability crime. Please, this is where we're seeing a lot of losses. I'm going to talk about it here in a minute, a little bit further. But if you don't take anything away from this, take this little point away. When you go back, get with your IT professional, whether in-house or if you hire a consultant. But you need to review if you have a couple open ports, and it's open port 445, open port 3389. If those ports are open, it's been explained to me, pretty easy to follow this. It's like keeping your back door open and then leaving it to go on vacation, right? It's just an open invitation to have hackers, bad actors get into your computer system. And this is how they enter into your system, is through these open ports. So make sure, again, go back, find out, hey, are these open? If they're open, you want to make sure you close them as quickly as possible. Employment practices liability, another area of risk that you really need to pay attention to because of these COVID issues. Again, a lot of it wage and hour violations. There's been an uptick in retaliation. So if you let somebody go, or supposedly because they were either saying something about COVID, they didn't want to work because of COVID, things of that nature, you got to really be careful. And there's certainly an uptick, and I think a lot of insurance companies are concerned about upcoming claims and suits under employment practices. We did talk about the builder's risk again, so I'm not going to talk about too much about that. But if you're doing a project over 10 million in frame particularly, make sure you don't think this is an easy placement. Don't use the rates that you used last year or that you got plugged into your rating system. You got to start early. Ask for multiple proposals. There's a lot more questions being asked by underwriters on these type of projects, and you want to give yourself adequate amount of time to get the proper proposal and get the information in. So drones, this is my last thing, drones. Just know, again, it's an aircraft, not covered by your policy. If you guys are using drones, make sure you get them covered properly. And lastly, again, particularly in Central Ohio, we're seeing more and more use of wrap-ups. Again, OCPs, CCIPs, it's either owner-controlled insurance program or contractor-insured insurance program. Take it serious. It's a risk management. You are insured under those programs, and don't ignore it. Just don't think it's a way to deduct your insurance costs. It's more than a deduct. It's an insurance program, and you want to understand it. Next slide. So I just want to talk about the cyber again quickly. This is an area where there are a lot of claims. Frequency is going up. A lot of it is because we work from home now, so many offices. The security sometimes is just not in place. when you're working from home, or I think people are just becoming a little bit more relaxed because they're working from their laptop, they're in a home setting. Whatever the reason is, we're seeing a lot of claims. And I'm going to tell you the number one is social engineering. If you've heard me talk before, you know I always talk about this. It's wire transfer fraud. The bad actors, the hackers, are getting very good at this. You know, they're sending you fake emails, asking you to pay to a fake bank account. They'll jump in the middle of a conversation, whether it's a subcontract or vendor supplier downstream. They've got onto your system, they're watching conversations, then they jump in right when you're ready to make a payment, and they typically will say, hey, we just changed banks. Here's our routing number. Thanks for doing business, you know, hugs and kisses and all that kind of stuff. You really got to have your staff trained to look for this kind of stuff. There's been these type of claims from an employee for direct deposit, and people have gotten caught. We went ahead and made the change and then deposited their paycheck into the bad account. Very sophistication. Number two, I think frequency and severity, and it's increasing, is ransomware, extortion ransomware, where malware is infecting your system. They lock it up, and then you get this nice email telling you, hey, we'll unlock it if you send us, you know, a lot of money. And they're very sophisticated. A lot of them come from overseas. Under a cyber policy, you get coverage for the ransomware up to whatever limit is on the policy. But what's really important on these type of policies is a lot of the insurance companies will step in and negotiate with the hackers, with the ransomware. They're very good at it, and they can reduce those demands many times, you know, just take care of it. It's unbelievable to watch these professionals the insurance companies hire to take care of this kind of situation, but it's a huge problem. So lastly, I just put down there, as far as cyber goes, on your next renewal, if you don't have it, I would suggest ask for a proposal, right? Just get a firm quote from your insurance provider so you got a number, then consult with your CPA, IT firm, even consult with your banker, get their opinions. Just make an informed decision if you want to have the coverage or not. At least at the end of the day, you think you got it covered, you got great security and great IT firm. If you don't want to take it, that's fine, but at least you're making an informed decision.
Hey, quick plug here, Joe, and you can also talk to your friendly Ray and Associates cyber team for risk assessment. Also a great idea. We partner with Joe and their firm on cyber stuff quite a bit, and it's something that's more and more prevalent, as he said.
Yeah, we can skip that slide. I pretty much talked about it, Abby, so we're good. And Doug, you guys, yeah, your IT firm does great. They'll come in and run some testing, and they'll look for those open ports, and they do other things. The firewalls, are they up to date? There's all kinds of things. It's just a rapidly changing, lots of risk in that area.
Well, thanks, Joe, and the entire team. We've got a few minutes here. We're scheduled till 10:15. If anybody wants to post any additional questions in the question box, we're happy to try and address those. And certainly want to thank everybody for their attendance today. Hopefully, a lot of good information that you received, no matter what your interest was today. We tried to cover a lot of stuff. Everybody will get a copy of the slide deck, and it's also posted there if you want to get it right now. A lot of great information, charts, graphs, etc. Obviously, feel free to reach out to any of us directly with questions. Always look forward to chatting and all that. Again, you should have received also an email with a Starbucks gift card in it. Make sure that didn't go to spam. That was not social engineering, right, Joe? That was actually valid. So make sure you look out for that. And there is, again, a follow-up gift for the early registrants as well. So you can be on the lookout for that. Don't see any questions right now posted. So we'll get final comments from everybody. We'll go in reverse order this time. Jack, what do you say? Any final comments?
No, I think we had a pretty comprehensive overview of where things are at in our neighborhoods, and I'm excited about 2021. I think it's going to be a fantastic year for everyone, and really excited about what we're going to do. So
I agree. I'm certainly more bullish maybe than some others out there, but I'm excited for the year as well. Dave, how about you? Any final thoughts?
Yeah, certainly optimistic about the number of opportunities that are going to come up in 21, especially here in Ohio. As we talked, nationally is one thing, but here in Ohio, I think we got a lot of good things going for us. And wish everybody the best of luck. And if anyone has any questions about Surety, about bonding programs, feel free to reach out. Love to have a talk.
Absolutely. We got a question again here. I'll address real quick before I get your comments, Scott. BWC refund count as gross receipts. At this point, this is related to PPP2. Yes, it does at this point. I know there's some, and you talked about this a little bit, Scott, there's some strong lobbying going on at the state level to try to exclude that from CAT tax and all that. We'll see where that lands, but I do know, at least for PPP2, at this point, that would count as gross receipts. Scott, any further comments?
Yeah, obviously I threw a lot of information out there today and had to rush through some of it. I think looking forward, I see that there could be a lot of tax changes possibly coming down the pike. And then, I mean, there's been changes over the past several years, and we continue to monitor those and how they impact the future. So from the state and local standpoint, I think there's going to be a lot of reaction to the federal component. And obviously we don't know all of those answers yet, as the states are now reacting to the legislation that passed right at the end of the year. So there's a variety of things from the state and local standpoint to keep an eye on as well.
Yeah, and I would, the only thing I would add there is, people get, I think, a little bit freaked out and overreact perhaps to pending tax changes that we don't even know about yet. And remember, the economy is really strong despite some of the headwinds related to COVID, and the economy grew quite significantly through the Clinton administration, through the George W. Bush administration, certainly through the Obama administration. So don't overreact, I guess, is my overriding point to any pending tax changes. Joe, any final comments from you?
No, I love listening to some of the forecasting on work. I agree with everybody. It should be a really good year. I think particularly for contractors, we're blessed to be in the construction industry. I'm blessed to be a service provider to the construction industry. I think it's going to be a great year. We just need to be smart and be well informed and be careful as we move through it, but it should be good.
Yeah. Well, thanks to everybody for attending again today, and a special shout out to our team, Imani, Abby, Emily, Joe. Thanks for helping us put on a smooth event and a great event. Hopefully folks enjoyed it and got a lot of good information. Any final things from a housekeeping perspective, Imani or Abby?
Yeah, thanks, Doug. I'll close it out for us. Thank you guys for joining us for today's webinar, third annual Construction Industry Kickoff. We hope the team was able to provide you with some valuable insight in regards to best practices and potential solutions. If you sign off today and realize that you have additional questions, you're always welcome to reach out to any of the presenters directly. And like Doug said, we thought for a special gift for our early attendees. And thank you again, and we hope you have a wonderful rest of your day.